Hello everybody and welcome back to my channel, Share Stockholm. Today I want to take you on a journey back to the late 90s when internet was at the center of the hope of everyone to become rich or the fear of being left behind. I'm talking about the famous dot-com bubble crash. I want to compare that period with 2 days and try to understand if we have the same risks for the new AI trend that's seen last year. Maybe you weren't even born, perhaps you don't remember it or weren't even interested on the stock market at the time. It was a period when the internet started to transform the way we live, work, and most of all the way we communicate with each other. All of that started in 1971 with Ray Tomlinson. With the invention of the @ symbol, he found a way to communicate in an instant with the apparent computers, and each computer had an email address. That idea gave the solution on the necessity of businesses to communicate more effectively with each other. That started to become viral in the 90s thanks to the email providers like Yahoo and Hotmail. Businesses and personal email have reached around 400 million of users, that's quite a lot. Now we can start with the major problem at the time. It was the birth of a plethora of new startups, visionaries and entrepreneurs, captivated by the idea of the magic words, the World Wide Web. Between Intel, Cisco and Oracle, companies that you know already, were leading the organic growth in the technology sector, and there was hundreds of other companies with now revenues, but with millions of dollars of investments available that fed the stock market and that climb that began in the 95. This was the birth of the dot-com bubble, a speculative mania that saw the valuation of these internet companies skyrocket to astronomical levels never seen before. It seemed like any company with a dot-com in its name could attract and send its stock soaring. Investors were caught up in the euphoria, pouring money into these companies with the belief that traditional metrics like the profits and the earnings were outdated because it was a new idea, new things. It was a gold rush of the digital age, and fortunes were made seemingly overnight. And the dream of getting rich quickly became a reality for some, or at least for a short time. However, as we all know, the higher you go, the more painful it is if you fall on the ground. And that is exactly what happened on the 10th of March 2000 when Nasdaq reached the highest value of $5,048. And from that day, boom, the crash has left behind hopes and dreams of normal people of becoming rich or at least wealthier than before, and they saw all their savings and gains made until then burned. Remember that at the time it wasn't like now. We have online brokers that let you sell in an instant with a click of our computers. The 10th of March was the last day of the August. After that was just falling until the 9th of October 2002, a date that closed the bear market era at 1,114, $4,000 less. So, what led to the birth of the bubble.com? It was a combination of factors. I think many of these companies were operating on hype rather than substance. We still have companies like that today, and they had massive valuation but little or no profit to justify them. When reality set in and the investors started to scrutinize the fundamentals of the companies, the bubble burst and the market correction was inevitable. It reminds us of the importance of the due diligence, not getting swept away by the crowd, the meme stock, and understanding that at the end the fundamentals of the company still matter. The dot-com bubble may have burst, but it also paved the way for the evolution of the internet and the rise of more sustainable and profitable businesses. And in conclusion, the dot-com bubble was a wild ride of excitement and speculation, and ultimately a cautionary tale about the dangers of unchecked optimism. But fast forward to today, I'd love to talk about AI. Yes, we are finding ourselves at the start of a new era again and another technological revolution. The AI, like it or not, is here to stay, and we need to take advantage of that. Much like the dot-com era, there are some undeniable excitement surrounding AI companies and technologies. Even at first glance, you can see that the parallels with the dot-com bubble are striking. The market and the investors are once again captivated by the promise of transformative technologies. And before we draw too many parallels, it's crucial to acknowledge the differences that might make this time distinct. One difference could be the tangible impact that AI is already having across the various industries. Unlike some dot-com companies that struggle to translate lofty promises into the reality, many AI-driven businesses are producing real and measurable results. From the healthcare diagnostics to optimizing supply chain, and the application of AI are far-reaching and in many cases are already providing their value. I personally have companies like that already in my portfolio or under my radar, waiting for them to reach the bottom. With continuous advancements in algorithms and computing power and data availability, in contrast to the speculative nature of some dot-com ventures, and the AI companies often have concrete use cases, and their technologies are evolving rapidly, reflecting genuine progression rather than mere speculation. However, it's essential to trade that company cautiously as well. Uh, as investors, we should be vigilant and ensuring that the excitement surrounding the AI doesn't overshadow the need for a solid business model and sustained profitability. So, are we headed for a repetition of the dot-com bubble in an AI era? The answer cannot be just yes or no. While there are parallels, the fundamental difference in the technology maturity and the real world applications and the overall market awareness suggests that this time could be indeed different. In conclusion, as we navigate the AI momentum in the stock market, let's learn from the lesson of the dot-com bubble and acknowledge the potential, but temper the enthusiasm with a critical evaluation of each company's. Our success will be from finding the right companies, buy when they are at the bottom and sell when they are at the highest. Finding another successful company with the right fundamental and repeat the process. And you should be prepared for another crash. As you can see for the graphic chart, we have another high wave right now. Thanks to the optimism of December inflation rate data and the Fed, they are telling us that they are ready to cut the interest rates. But I think that we are not swimming in safe waters yet. So be careful and let me know what you think about the AI and which companies you like. So I can check them here with the fundamentals and everything, but stick together and share ideas and news, because I think this is the right way to move the market on our side. Thanks for watching. If you like the video, please give me the like and share with your friends. Subscribe to my channel to see which companies are in my radar, and see the next videos. We hear in the latest news, learn about the fundamentals and how to read the charts and the signals, just in the next videos, and much more. Subscribe.